right? Oh, all right. So we can start now. Actually, my center here is called Hybrid Financial Consultant, so that's no issue. This is not part of our topic today. So our main
Okay.
topic,
Just to make sure, I noticed that you're recording this lecture.
yes.
Do you want me to hold questions until the end of the lecture, or can I ask how do you want this to be?
What I just didn't get you. What did you say? What did you just say?
Do you want me to hold all questions I have till the end, or because you're
No
recording, do you want
problem,
me
no
to,
problem. You just
am I allowed to answer?
don't worry. Just ask whatever you
Okay,
wish.
thank you.
All right. Feel very free.
Thank you.
So our topic today is marginal and absorption costing. First of all, you truly need to know what is marginal and absorption costing. Why are they used? First of all, let me refer to the income statement. I hope you know the income statement, right? And
Yes.
it usually starts with sales, and then we come to cost of sales, and we get gross profit. Now, our main concern is on cost of sales. Cost of sales contains inventory, right? And actually, when speaking of that inventory, that's where marginal and absorption costing systems come into play. What we are asking ourselves is, should that inventory contain both fixed and variable cost of production, or should they merely contain variable costs? That's our question. Marginal and absorption costing systems answer our questions. So, simply speaking, when speaking of marginal costing system, we value our inventory using variable production costs only. While when speaking of absorption costing system, we value inventory using both variable and fixed cost as long as the costs are related to production. All right. So that's what we are saying. These are inventory valuation systems with which product costs comprise of full cost. Full cost means both fixed and variable, or variable cost of production, just like I've stated previously. So that's why, as I said, absorption costing system recognizes fixed production cost as part of cost of output. Simply speaking, they recognize fixed cost as part of inventory, and so product costs. But when speaking of marginal costing treats fixed cost as period cost. You know, when learning about cost classification, there is a classification by function. Let me speak of it here. There are two major classifications spoken about here. Cost classification, you can classify by function. When saying you classify cost by function, what do we mean? We classify cost into production costs as well as into non-production costs. This is classification by function, but also we could classify our costs actually by behavior. Cost classification by behavior. And if you say by behavior, we say that we have variable costs, we have variable costs, but also we would have fixed costs. So this is what we do. So as you see here, I've spoken of all of the two situations already. So simply speaking, when we speak of marginal costing system, we use variable costs, but related to production, because our main concern here is on how to value costs of inventory costs, and inventory would usually be related to production. Inventory would usually be valued using production costs. And so these production costs actually can be fixed, but also they can be variable. So when speaking of marginal costing, we use only variable costs. But when speaking of absorption costing system, we use both fixed and variable costs. That's what we do. Now, if you just saw what we did there, I said that we use variable costs to value inventory for marginal costing. So if we use only variable cost, where do fixed costs go? Oh, we treat fixed cost as period cost. Usually, costs that are not related to inventory are treated as period costs. That means they are taken to the income statement as operating expenses. As you know, the income statement has sales, cost of sales, we get gross profit, and thereby we actually deduct operating expenses. So you could have your sales here, here. And then you could have your cost of sales, as I just show here, all right? And after having cost of sales here, you would remain with gross profit, like you see here. This is gross profit. And after your gross profit, down here would come to operating expenses. Operating expenses, actually, they are just treated as period costs. They are just deducted as they incurred. So this is the main point. So when speaking of marginal costing, this cost of sales, as I said, when speaking of marginal costing system, this cost of sales here would have variable costs of production only, strictly only. Where do fixed costs go? Fixed costs come here as operating expenses. That's why I say they are treated as period costs. But when
When you
speaking of,
say variable costs,
all
yeah,
right,
when you say variable costs, can you elaborate what exactly is
all right,
variable
all right,
cost?
all
Is
right.
that the labor, materials,
All right, all right, all right,
direct
all right. I got you.
expenses?
I got you. So it seemed like you haven't taken a look at variable and fixed cost. I think I would also prepare a video on cost classification. I'll go on that. Don't worry at all. If you don't know about that, I'll read all. Let's just take a look to know how we do this. All right.
Okay.
When you go to absorption costing, as I said here, cost of sales would comprise both variable costs as well as fixed costs. You know, when told period costs, it means that all costs incurred, it means that if you retain inventory, that cost is just taken to the profit and loss directly. But when you say that the cost is taken to inventory and the period has ended and they still have inventory, that means part of that cost would be retained in the inventory. And so it wouldn't be treated as period costs. So that's what we're just going to take a look about. All right, let me go to variable and fixed costs. Simply speaking, there are several ways of cost classification. Let me list them before going further to explain this, because it is a very, very important part, especially for you in F2 management accounting. Cost classification could be by function, could be by behavior, but not only this. Cost classification could also be by nature. We say by nature, or in other words, we say by traceability. Traceability, right? This is cost classification by traceability. And when speaking of cost classification by traceability, there are matters that we'll refer to. First of all, we refer to direct costs. Let me write them all because I think you need to know them all. Direct costs, but also we could have indirect costs. So we have both of them. So we have indirect costs, just like this. But further from here, there are several, like you just said, we just spoke of material, labor, and overheads. I'm just starting to clarify now. We have cost classification by elements, elements. If you say, because you have classified costs by elements, that's what we refer to. You can have materials. Any product that you make would have materials, but also any product that you make would have labor. Actually, we expect to have other expenses. Actually, any product you make would have other expenses. Just say expenses. And so, to make these matters more even clearer, if you have materials, you can have direct material, but also you can have indirect materials, right? When speaking
Right.
of labor, you can have direct labor, but also you can have indirect labor. Just like when speaking of expenses, which are rarely spoken of, you can have direct expenses, but also you can have indirect expenses. Now, indirect materials, indirect labor, and indirect expenses are collectively known as overheads. Overheads simply mean indirect costs. So we call them overheads. So
Overhead.
by just seeing such overhead there, you can just see how these matters are somehow interrelated. And when speaking of direct costs, there is another term that is called the prime. So we call them prime costs. So this is what we do here. I think everything is clear now. It's actually a bit clearer. By elements, we just mean the element that will comprise that when making the product, you pass through them. So let me go back here. Actually, there is another classification, but it's of less relevance here. We say classification by relevance, actually. That actually is important in decision making, saying which costs are relevant and which are not. So I'll just keep it here. So let's just go here. Cost classification by behavior, we actually just go and take a look on how costs vary with the changes in activity levels. That is, let's say, suppose you produce more units, what would happen to the cost? There are costs that when you produce more units, they remain constant. We call them fixed. So fixed costs are costs that remain constant regardless the changes in the level of the activity. Making one product, you incur fixed cost of, let's say, $200. 2 units, the same. 3 units, the same. That cost is called fixed, but we have variable costs. By saying variable costs, we say that it are the costs that vary whenever a unit changes. You add a unit of production, the cost increases. You add a unit, a cost increases. So these vary with the variation in activity level. When activity level changes by 1 unit, they vary. I hope you got me now. These vary.
Yes.
They change with the changes in activity level. For every unit that changes, they also change. So this is what we mean by variable cost. This section is very, very essential. You should take a look at it. So simply speaking, to help you further, let me just be excessive because you not know you not have an idea on this. Normally, variable cost when measured on a per unit basis is constant. Variable cost per unit does not change. It is usually the same, right?
Mm-hmm.
It's like let's presume what, let's say that when you need to make a table, you require timber costing you let's say $10. You require timber costing you let's say you require timber costing you $50. That means if you make one table, you would incur $50 per timber. If you make the other another $50, you make the other another $50. That's the minimum of variable cost. That's why to say on a unit basis, they are the same, they are constant, right? But when
Right.
speaking of fixed costs, it may arise that fixed cost in total is the same. So variable cost per unit is constant, but fixed cost is constant when regarded as a whole. Suppose someone needs to make tables, they would need to rent, let's say, a warehouse to do that. Renting a warehouse could probably cost them charges, let's say $1,000 per month, something like that, maybe $500 per month, things like that. That means that whether you produce a table, you make a table or not, that's up to you, but you would have to pay for that amount of $500 each month. That's why they are fixed. They are there regardless of the changes in activity level. I hope you got me. Now just go further because we haven't gone up
Yep.
to this. I could add something a little. You know, even fixed costs sometimes change. Fixed costs can be there are costs called semi-fixed costs. If you speak of semi-fixed costs, what do we mean by semi-fixed costs? There are costs that are fixed just up to a given activity level after which they change. Let's presume the same person, let's say a carpenter. A carpenter is making tables and he has rented a warehouse. Let's say that warehouse actually is capable of accommodating a maximum of 50 tables. So it transpired that when that capacity of 50 tables is exceeded, that carpenter would obviously need to rent extra space for other tables. So the carpenter would have to incur extra costs for which that cost would further change after that capacity is exceeded. So we call them semi-fixed costs, or simply speaking, we call them step fixed costs. Step fixed cost. They are they are fixed, but they rise in steps. They rise when the capacity is exceeded in such a way that you need to rent another resource. You need to have an extra resource. So you can have semi-fixed cost. Just like on variable cost here, you can have semi-variable costs. having variable costs. You know, there are costs, and we usually take a nice example in telecommunication companies. When going to telecommunication companies, it could happen that, I'm repeating again, when going to telecommunication companies, it could happen that you are told maybe to be provided with a telecommunication line to your home, you would have to pay for service charge. Maybe each month you would be required to pay $10, regardless of whether you make a telephone call or not. That is a fixed amount, but also you could be required to pay maybe $0.5 per each call you make. That means there is some kind of variable cost that you pay for each call you make, but also there's a fixed amount. We also call that semi-variable cost. So speaking of all that, we always refer to one conclusion that total cost when measured by behavior equals to fixed cost plus variable cost, and the variable cost of which is defined as variable cost per unit times units. So you have to take a note of this. This is what would constitute what we do further. So just take a great note on that, right?
I'm writing it now.
Yeah, right. So I think
So what was that? Is total cost, you said,
yes,
which equals to fixed cost
plus
variable cost
total. And total variable cost equals to variable
times
cost per unit times
quantity.
units. VCU means variable cost per unit. So you multiply by units to arrive at your answer, right?
Yeah.
All right. So I think you can proceed further now. Let's now go to our main topic, our main concern. So going back to our main concern, as I just told you, I think now it's somehow clearer. When you just see the word marginal and absorption, do not worry about how we go about. Just know that marginal involves valuing inventory using only variable cost of production, while absorption costing system involves valuing inventory using both variable and fixed cost of production. So that's what you have to know. So just a bit of point here, although you'll find it later, I will say that valuing inventory using variable and fixed and variable cost only or using variable and fixed will normally lead to different profit figures, except for some situations when values of opening and the closing inventories are the same. Do not worry about this. Actually, we'll take a look at this. You will find out later that when opening inventory and the closing inventory units are the same, there will be no difference in profits of income statements by using marginal or absorption costing. The profits or losses would be exactly the same. So let's shift our focus to marginal costing. I think you have spoken a lot about this. You can just go fast now. So as I said, marginal costing, the method is also, first of all, the method is also termed as variable costing system. Why is this also called variable costing system? This is because it values inventory using only variable costs. I decided to be specific here after a full stop of production of cost. That's obvious. When valuing inventory, you would obviously use cost of production. As I told you, classifying cost by function, you would have production and non-production cost. Production cost will naturally belong to cost of sales, while non-production would belong to operating expenses. So that's our main concern when speaking of marginal and absorption costing. So the marginal costing is also referred to contribution costing system. Why do we call it contribution? I don't know if you have seen it already, but I told you that cost can be classified into variable and fixed. So when speaking of profit, we would say that profit equals to sales minus total cost. And sales total cost is divided into variable and fixed cost. I would actually say this. Let me write this down. You have to get a full grasp today. I would say that my profit actually would be equal to sales here, less cost. And my cost, as I said below, I just said previously, I said that my cost would constitute variable and fixed cost. So I would less variable cost, but also I would less fixed costs. Now, sales minus fixed cost is what we call contribution. You could ask yourself, where did this term come? Where did this term come from? Why do I call them contribution? We call them contribution or contribution margin. Why this term? Contribution simply means, it is a contribution towards covering fixed costs. As I told you, when a carpenter just actually commences business, having rented the warehouse, he would have paid for rent and other fixed costs. So even before producing anything, even before incurring any variable cost on production, actually he would have incurred these fixed costs. So when making sales, that means that whenever he makes a single product, he would have incurred a variable cost per unit, expecting to recover that cost from sales and ultimately making a profit. So the excess of sales of a variable cost before subtracting fixed costs gives you the contribution. So simply speaking, contribution equals to sales minus variable cost. This is what we call contribution, or called contribution margin. Just like you say profit margin, contribution margin is just another term here. So you get a point. That's why I say that when speaking of marginal costing system, simply speaking, profit equals to contribution margin minus fixed costs. I hope you get me now.
Yeah.
All right. So when speaking of this variable cost, as I told you, here we contemplate on whether the cost is related to production or not. So when speaking of this variable cost, you would have to make a separation. Variable costs that are related to production, that would constitute cost of sales, and variable costs that are not related to production, just like this. So after having done this would constitute cost of sales, and this non-production cost, you just take all other costs. So what you need to do is just to make a clear separation between the variable cost. Make for production, which form cost of sales, and make the rest. Then combine them to have total variable cost, the total of which is subtracted from sales to arrive at the contribution margin. About fixed costs, do not worry at all. Just subtract all fixed costs as you see fit. No need to contemplate on anything. So
these non-production costs, does that include things like
all right, very
delivery,
nice, very nice.
selling?
Simply speaking, non-production costs are costs that are out of the production department. Simply speaking, in a production department, you can have assembly workers. Let's say you're assembling cars, you can have assembly workers, those are labor. You can have materials used to make anything that you are making. Those are direct costs. They are production costs, but they are direct. They can be traced in full to a particular product. But actually, you'd have a factory supervisor. That's a nice example. A factory supervisor actually is just supervises. That's not a direct cost. It's an indirect cost, but still it is in the production department, so it's a production cost. But simply speaking, non-production costs just consider all costs outside the production department. Cost in the HR department. All costs in the HR department are non-production. All costs, for example, let's say in the all costs in the, let's say, finance function, they're non-production. Costs in the administration function, they're non-production. I don't know if you get me.
Yes, I get you.
Yeah, just presume just presume to see a company with a production department and all other departments. Costs in all other production departments are non-production costs. Having done that, you will easily see them. Selling costs, you have gone and sell a product, those are non-production. It's like their marketing costs. So we just go that way, right?
Okay, so we add that all towards the or we subtract that from, we add that to the production costs in order to get the contribution. So sales minus those direct production costs,
all right,
and those non-direct production costs.
Yeah, and you actually do not worry at all. I've made clear all performance. All performance are there to see. I'm just trying to make you have a true grasp before just going to the performance. Everything is there, but I just need you to have a real concept.
Okay.
All right, so we can proceed here. That's why I said contribution simply means sales minus variable cost. But here we separate variable cost related to production, that is variable cost of sales, and variable cost that are not related to production. That's why I've separated the costs here so that you understand you have to separate them too. All right, we go further now. We say that after that, all other costs that are non-production costs and all fixed are treated actually are treated as period costs. So all costs, be it variable or fixed, they are treated as period costs, but that's none of our concern. I've already shown you how to deal with variable cost of non-production. So simply speaking, we just do that. These are actually, there are other explanations, but no need because actually I've stated it all. So simply speaking, as you initially told me that, oh, let me tell one thing. There are actually costs like material costs, labor costs, overheads. This is where that comes into play. Most questions on marginal and absorption costing, actually, they give you cost of products element-wise. So you can have direct materials, you can have labor, that is direct labor, but also you can have variable overheads. Now, if you see this, actually, I think you can get more grasp of what I was just speaking about. Now you can see direct costs and overheads. Overheads simply mean indirect costs. I think I spoke of this earlier on. What did I say? I just said this. I said this one. I said here, if you take a look, I said you can have direct materials, but also indirect materials. Then I said you can have direct labor, and also you can have indirect labor. And I said you can have direct expenses as well as indirect expenses. Actually, it's common that most expenses are regarded as indirect. So in the performers, even they say performers, actually, they rarely consider direct expenses here. Now, you can also ask yourself one thing. We just said you're just going to value inventory using variable cost. But look here at this pro forma. We have said direct material, direct labor, and variable overheads. Why? This is just direct cost, not variable cost. The normal presumption is direct materials are presumed to be variable unless told otherwise, because by saying direct material, it's like you're making a table. As I just told you, maybe you need a certain amount of timber. So whenever you make a table, you would need that amount of timber. So it's direct material, and we expect it to be actually we expect this direct material to be variable. The same applies to labor, but this is not usually the case. You know, you can have labor that is paid on a monthly basis, so that cost cannot be variable. But we usually, unless told otherwise, we just presume them to be variable. So this is a very, very important point that you should note, so as to go well in your studies. So just get a grasp now. Direct material is what I just spoke of. I just spoke of. You see it there. You have direct labor. You see it there. As I told you, direct expenses is rarely seen because maybe if you are given, you can also put it there, but you are not given, so just ignore it. Now just go and see here. Indirect materials, indirect labor, and indirect expenses. Indirect costs are collectively known as overheads. That's why you're not seeing the word indirect, but it is actually incorporated here. We just decided to be more clear and say that these are overheads, they are related to production and they are variable because marginal costing uses only variable cost. Because we can have variable production cost as well as fixed production overheads. You can have variable production overheads as well as fixed production overheads. So our concern here is on variable. That's why we have ignored fixed. When you go to the absorption costing system, you would see the same here, but we would add fixed production overheads. I hope everything is well up to there.
Yes.
All right, so we proceed here. We say below is the standard cost card of the marginal costing system. You know, we presume inventory to be measured based on standard costs. We just presume them to be measured on standard costs. Standard costs actually are costs that are usually prepared. I think we'll see them. Have you gone through standard costing or not?
Yes, already, yeah.
Yes. Also, a nice example on standard cost, let's say when speaking of direct materials, we just say that when speaking of direct materials, we just say standard quantity times standard price. Standard quantity could be maybe, let's say, making a product requires 2 kilograms per unit, and then you will multiply by standard price SP, and this SP here would be, let's say, TZS, or maybe let's say it could be dollars, maybe $25 per watt per kilogram. So something like this, and if you multiply them